Australian prices might be going higher, however, we have some real serious concerns when it comes to the job market, wage growth, and everything in between for the Australian economy. In this video, I want to figure out, is it that property prices can be sustainable at this point, or is the Australian economy heading for a recession and perhaps a collapse in the next year or two? And if you're someone that's renting, how is that going to affect you? And even better, if you have a mortgage, how is that going to affect you? If you're interested in what my thoughts are, definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. Now, I occasionally talk about the Australian economy, and in this video, we're gonna go through some data as well as some of my thoughts. Why it seems like you could go and talk to 10 people on the weekend. I don't even know 10 people, so let's scrap that and say 5 people. You go and talk to 5 people over the weekend, and you find such different opinions. Some will go, oh, my rents are going up. Others are saying my rents are actually okay. Others that have a mortgage have their rates going up. And others that have a house that now they're using equity to go and buy another house. It's actually crazy to think how divided the country has become when it comes to personal finance. So let's go through some real key figures and then we're gonna wrap it all up together and figure out what happens next. Because hey, who doesn't love crystal ball predictions? Because we always get them right on this channel, don't we? I clearly don't, so let's just continue. Yarra Capital Chief Economist Tim Toohey warned that Australia is not creating enough jobs to soak up the large numbers of migrant workers arriving, which risks pushing the unemployment rate sharply higher. Since mid-2023, a new phase commenced, whereby the strength in net migration was more than sufficient to supplant non-migrant workers in the workplace, generating a trend rise in the unemployment rate. In other words, net migration is currently supplying 1.4 people for every new job created. That means we have way too many people relative to how many jobs are being created. And the latest figures that came out of SEEK also suggest the same thing. So what we have here is the June 2024 numbers from SEEK. And what we can see is national job ads month on month have reduced by 1.5%. National job ads 2024 June versus June 2023 are down 17.1%. And applications per job ad month on month have increased by 3%. And this graph here showcases exactly what's been playing out. What we can see is in the red, we have job ads, and in the blue, we have applications per job ad. Now, what we saw is during the period of the lockdowns, we naturally saw job ads went down, but applications per job went up. Because if you think about it, people were stuck at home, probably lost their jobs, so they're going, now I need to go find a new job. Whereas most businesses were shutting down and locking down, so they were like, we can't actually advertise for as many roles. So that makes sense. Now what we're seeing is the inverse effect. And what we've experienced in the last couple of years is that the number of applications per job ad reduced, whereas job ads increased. Because as the lockdowns got lifted, you had some companies taking off and they needed more people to work there. We obviously as individuals also got a lot of stimulus from the government, what's up government, and they expected us to use that money in the restaurants and cafes, and given that we weren't traveling, everyone's like, hell yeah, I'm gonna spend all that money. So that meant that the cafes, the restaurants, the companies out there, and services like ourselves, like the buyer's agency, also took off. So we needed to hire more people. What we saw during that time was it was very hard to find the right talent because there were too many jobs for not enough people. Now what we're seeing is the opposite trend start to play out again. And what we're seeing is that job ads from companies are starting to reduce. And I have a theory about that, which I'm going to share with you in a second. But the amount of people that are applying for those jobs have started to increase. Now, my theory behind this is that we have some sectors really suffering during a period like this. We've seen so many companies go bust, especially in the building and construction industry. And that's largely because of interest rates. Now, if you think about this with interest rates not only affecting businesses, but also potential customers, let's cover that off. From a business perspective, if you have interest rates higher for longer, which it's actually been, you may have those companies carrying on some potential debt against things like inventory, there might be a coffee machine, there might be machinery, and there might just be business loans just to get the business up and running. If the interest rates have stayed higher for longer, the repayments on those loans stay higher for longer, which has now meant it's starting to squeeze. What would further compound this problem is that when customers aren't spending as much. Now again, if you've got interest rates also high, you then have people suffering from higher rentals because there's not enough properties being built, and that's because no one wants to take on another loan. If you actually think about this, for you to go out and build a new home, not only would you have to continue renting your place, or if you're say living in a place that you've already got a mortgage on, you would still have to do this, plus you would have to take up a loan for the build and the land component. Now, the construction loan would be done in stages, but effectively it's like 12 months at minimum to build the house. So for 12 months, you've got to effectively pay 2 mortgages or rent plus another mortgage. And not everyone can do that, especially right now when the cost of living crisis is where it's at. So then you've got people who aren't willing to spend as much. And if they're not willing to spend as much at these stores and these cafes and restaurants, you suddenly have these companies not having to hire as many people, and the negative loop flow continues. And this is why we're in a position now where if we're starting to see these numbers invert, where job ads are going down and there's more people applying for work, you're gonna start seeing the unemployment number go up. Now, what's very important to bring this all back home is the RBA has come out previously, and although they have had a track record of, let's just say, lying to us about whether interest rates will go up or down, they have said one thing, which is if unemployment starts going up and it hits 4% or 4.5%, we will have to cut. And that's irrespective of what inflation is doing. So that is very important when you consider whether you're going to make a decision on continuing to rent or whether you're going to buy your own property, take out more debt, is just knowing it is not just about inflation. You need to consider the economy's health in general. And this graph here is the unemployment rate versus job ads. And what you can see is that job ads usually will be the first indicator that go up or down, and then the unemployment rate follows. So what you can see if you go back in time, you can see in 2012, in this, the blue is job ads inverted, so it's the opposite. So if the number goes higher, it's actually going lower. And in this case, the unemployment rate, just to show the correlation between the two. So you can see job ads actually going down, although in this graph it's inverted, so it's going up. You'll see that this goes first and then unemployment goes up. You can see it in the 2020 section, where you've suddenly seen the blue line go up first, then the red one follows. And now what we're seeing is the blue line is so much further ahead. That is the other thing. The correlation between the two is very closely linked. So if we're starting to see this gap, either one of two things will happen. One, you see job ads actually go up during this time, or you're gonna see the unemployment number go up. And either way, you're gonna see some sort of volatile change coming soon in the next 6 months. And that's why you need to stay prepared. And to further emphasize this point and bring it all home is the unemployment rate versus job applications. You can see that this graph has never had such a big gap between the two lines. One being applications per job ad and the unemployment rate. It means that a lot of people are applying for jobs and there's just not enough out there. Now, what doesn't help this situation is where the consumer sentiment actually is. Now, consumer sentiment is effectively just a gauge of how negative or positive people are feeling out there. Are they optimistic that the market's great, I'm gonna put my money into the markets and I'll make some more money? Or are they negative about it, suggesting that we may see some sort of crash and therefore I'm gonna hold back my money? And what you can see here from Westpac Economics is the number of 100 being all average. So that's the balanced market. Anything below this number is fearful. Anything above this number is greedy. So if you think about Warren Buffett and says, buy when others are fearful, sell when others are greedy, this would be a really good indicator. And what you can see is that we've got consumer sentiment at these lows for the longest period of time since 2008. As this graph covers off, it's at the points that we've only experienced twice before in the last 20 odd years. And that is during the GFC, and then we had the lockdowns. So what you can see is that when we were in the GFC, it seemed like we were there for a little bit and then we bounced up. What you can see is during the time of the lockdowns, we were there for a brief couple of moments. And again, that double dip was because we ended up having lockdowns again, and then we shot up. But now what we can see is that yes, although the consumer sentiment is slowly rising, we're still getting affected by the fact that inflation is higher than normal. And that means interest rates could go up on the next meeting, and that is holding a lot of people back from actually going out and purchasing investment properties. Now, if I'm to conclude all of this and bring to you what my thoughts are around real estate investing and why it still could be a really good opportunity for you, is because you want to be buying when there's fear out there. But you also don't want to buy when you're about to lose your job. And this is why it is such a complex conversation. Is it just interest rates going up and down? No, because there's cause and effect of that. If you then marry that up with building approvals and where we are at such shockingly low numbers when it comes to supply of new quality homes, you're then going to realize, hey, there's not enough homes, there's not enough jobs, yet property prices continue higher. And why is that? Because it comes down to one simple thing: supply and demand. I know I've covered off a lot of data points here and shown you some graphs. This is the key takeaway from the entire video. It's that even though the Australian economy could be sick, or it could go through a recession, or that there's a lockdown, that does not automatically mean that property prices will go down or up during that period. If you look at 2008, 2009, you had the GFC, we had a small blip in terms of prices and they bounced straight up. If you look at something like 2016 to 2018, you'd be like, the economy was actually doing pretty well, but you had property prices go down. And that's because the availability of credit was the main factor there. APRA kicked in and they said, hey, we're gonna have restrictive lending conditions, and that's what held us back. Then you look at lockdowns, and during lockdowns, the Australian economy went through a recession. However, interest rates went down, you also had unemployment go up, but property prices went on the biggest run ever. So there's a lot to unpack, especially when it comes to economics and looking at the housing market, and that's why so many people get stuck at 1, 2, or 3 properties if they're lucky, and some will never even make that purchase. I have conversations like this every day, whether it's strategy sessions, discovery calls, or talking to the client account managers who are talking to people every day, suggesting that some people just have analysis paralysis. And for me personally, these numbers are important, but they're not everything. What you want to do is go and build a property portfolio with a strategy and have the emergency funding in place. If you go and stretch yourself during a time like this, it might not be the smartest decision, especially if you're in a job that is in a volatile job market. If you're someone that's confident, you run your own business and you can forecast the next 24 months and things are looking good, I would definitely be more aggressive now, especially because we have a severe supply shortage and there's so much negativity out there. We are so far from the top, because generally what makes up a top in the market when you're about to see a collapse is when everyone is euphoric. Everyone thinks the market can never come down, and trust me, it doesn't feel like that right now. I hope you guys have enjoyed this video. If you have, smash that like button, subscribe if you haven't already, and share this video to someone else that might be just stuck overthinking a bunch of stuff, when in reality you just need to own land and keep owning more land and more, and continue watching these videos. I'll catch you guys in the next one. Thanks guys.